Are you familiar with the concept of diversifying your investment portfolio for a brighter financial future? If you've considered the potential of acquiring rental properties, you're on the right track to secure a steady stream of passive income. However, there's an additional dimension to this investment strategy that could significantly improve your financial outlook during tax season. Join us in this video as we delve into the fascinating world of real estate investing and uncover the hidden financial perks it offers when it comes to taxes. You'll discover a wealth of information on the numerous tax advantages associated with real estate and gain insights on how to optimize your yearly tax returns. 1. Use real estate tax write-offs. Among the most appealing aspects of this income avenue are the tax deductions that come with real estate investments. You have the opportunity to offset your financial obligations by deducting expenses directly associated with the property's operation, management, and upkeep. These expenses encompass a wide range of essentials including property taxes, property insurance, mortgage interest, property management fees, costs for maintenance and building repairs. But here's where it gets even more exciting. Did you realize that you can also claim deductions for a substantial portion of your real estate investment business expenses? These qualified business expenses extend to various categories, including but not limited to advertising, office space, business equipment, such as computers, stationery, business cards, and more, legal and accounting fees, travel. By leveraging these deductions, you can significantly reduce your taxable income, ultimately resulting in tax savings. To illustrate, if your annual rental income stands at $25,000 and your eligible business expenses total $8,000, your taxable income from your real estate venture shrinks to a mere $17,000. Pro tip: to safeguard your financial interests, it's essential to maintain meticulous and accurate records, as well as hold on to receipts that substantiate your claimed expenses. This ensures you're well prepared in the event of an IRS audit. If you want to continue exploring the world of real estate investments and tax benefits, don't forget to subscribe to our channel. By subscribing, you'll stay informed and gain access to more insightful videos just like this one. Don't miss out. Hit that subscribe button now. 2. Depreciate costs over time. Depreciation, in the world of real estate investing, refers to the gradual reduction in the value of an asset, primarily due to the wear and tear it undergoes over time. As an astute real estate investor holding income-generating rental properties, you have the unique advantage of deducting depreciation as an expense on your tax returns. This not only serves to lower your taxable income, but can also potentially reduce your overall tax liability. The IRS currently allows you to claim depreciation deductions for the entire anticipated lifespan of a property. For residential properties, this is typically set at 27.5 years, while commercial properties have a depreciation period of 39 years. To illustrate, let's say you've acquired a home to rent it out. The building itself, excluding the land, has an appraised value of $300,000. By dividing this value by the 27.5-year expected lifespan of the property, you can claim an annual depreciation deduction of $10,999. However, it's important to note that when you eventually sell the property, you'll be required to pay the standard income tax rate on the depreciation you've previously claimed. This obligation is commonly referred to as depreciation recapture. To potentially mitigate this, explore alternative tax strategies like the 1031 exchange, which we'll delve into shortly. Pro tip: for a comprehensive approach, consult your accountant regarding the depreciation of significant improvements made to your investment properties, such as a new roof. 3. Use a pass-through deduction. The pass-through deduction is a tax benefit that allows you to deduct as much as 20% of your qualified business income, QBI, on your tax returns. When you're the owner of rental properties as a sole proprietor, involved in a partnership, or operate through an LLC or S corporation, commonly known as pass-through entities, the rental income you collect is classified as QBI according to real estate tax regulations. To illustrate this concept, Let's consider a scenario where you possess an LLC that holds ownership of an apartment complex, yielding $30,000 in rental income each year. Leveraging the pass-through deduction, you have the opportunity to deduct up to $6,000 from your tax return. Keep in mind that some specific rules and regulations must be followed, so it's advisable to consult with your accountant to ensure proper compliance. A critical point to note is that this tax advantage, along with various other provisions outlined in the Tax Cuts and Jobs Act of 2017, is currently scheduled to expire in 2025. 4. Take advantage of capital gains. When it comes to real estate investments, it's crucial to understand the implications of capital gains taxes, which may come into play when you sell a profit-yielding asset, such as a piece of property. There are two distinct categories you need to be aware of: short-term and long-term capital gains, each exerting a unique impact on your tax situation. Short-term capital gains. Short-term capital gains occur when you realize a profit from selling an asset within a year of its acquisition. While there may be situations where you have no option but to sell in the short term, it's essential to recognize that this can have adverse effects on your tax liabilities. The reason is that short-term gains are treated as ordinary income, meaning they get added to your existing income. For instance, if your day job yields $100,000 in income and you sell an investment property with a $100,000 profit within a year, your total income effectively doubles for tax purposes. If you're filing as a single taxpayer, this extra income might push you into a higher tax bracket, potentially resulting in a larger tax bill than anticipated. Long-term capital gains. On the other hand, long-term capital gains come into play when you profit from the sale of an asset you've held for a year or longer. Waiting until the first anniversary of your purchase to sell can be financially advantageous. Long-term capital gains are subject to considerably lower tax rates compared to standard income. Moreover, if your income falls within certain thresholds, you might even escape taxation on your long-term capital gains. Consider a scenario where you and your spouse collectively earn $75,000 per year and file a joint tax return. In such cases, the tax rate for your income level is 0%, making your long-term capital gains tax-free. This translates to keeping every dollar of profit when you decide to sell a property. 5. Defer taxes with incentive programs. Occasionally, the government introduces specialized tax codes to incentivize and reward investors. Today, we'll delve into two prominent real estate tax benefits: the 1031 exchange and opportunity zones. 1031 exchange. The 1031 exchange is a provision aimed at rewarding individuals who reinvest their real estate gains into new ventures. Here's how it works. When you purchase a new property of equal or greater value than the one you're selling, you can exchange it for tax purposes, enabling you to defer paying capital gains tax on the sale of your initial property. The beauty of the 1031 exchange lies in its flexibility. You can employ this strategy indefinitely. However, when you decide to cash in your profits, the accrued tax liability will need to be settled. Given the intricacies of the program, it's advisable to seek guidance from a qualified financial professional to navigate and maximize its potential. Opportunity zones. These zones, designated by the U.S. Department of Treasury, encompass low-income or disadvantaged areas. In a bid to encourage investments and stimulate economic growth in these communities, the 2017 Tax Cuts and Jobs Act offers tax incentives to investors. As a real estate investor, you can channel your unrealized capital gains into a qualified opportunity fund. The funds collected are then directed towards the development and enhancement of the chosen area. By adhering to the program's guidelines, you can reap the following tax advantages. Defer capital gains tax payments until 2026 or until you sell your stake in the fund. Witness a 10% increase in your capital gains if you hold the fund for 5 years and a 15% increase for 7 years. Completely sidestep capital gains taxes if you remain invested in the fund for a decade or longer. These real estate tax strategies hold incredible potential, but they can be intricate. To make the most of them, it's prudent to consult with a financial expert well-versed in these matters. 6. Be self-employed without the FICA tax. When you're self-employed, it's a standard practice to be responsible for both the employer and employee portions of the FICA tax, which covers Social Security and Medicare. However, owning rental property introduces a unique tax advantage that often remains in the shadows: exemption from the FICA tax, also known as the payroll tax. Here's how it works. Imagine you operate a freelance writing business that generates $50,000 in annual revenue. Since this income is considered earned income, you would typically be subject to the payroll tax. At a rate of 15.3%, this would require you to allocate $7,650 to meet your tax obligations. However, if you are the owner of rental property, this particular financial burden no longer applies, allowing you to preserve that money in your bank account. This is a powerful advantage that many people in the self-employed sector are not fully aware of, making it a significant hidden perk of investing in rental properties. Investing in real estate offers a multitude of hidden financial benefits that can significantly impact your bottom line. We hope this video has shed light on the valuable tax advantages and strategies available to real estate investors. If you're eager to delve deeper into the world of real estate with 10K, simply click on the video displayed on your screen. There, you'll uncover even more insights, tips, and strategies to maximize your real estate investments. Thank you for joining us, and remember, your financial future is within your grasp. Happy investing!